Gold is supposed to rise during times of uncertainty. So why is gold falling right now? After the Federal Reserve decided to keep interest rates unchanged and tensions around Iran escalated, many investors expected gold prices to surge. But instead, gold is dropping. To understand this, we need to look at how markets actually work. First, let's talk about the Federal Reserve. When the Fed keeps interest rates high, or signals that rates will remain elevated for longer, it strengthens the US dollar. A stronger dollar makes gold more expensive for investors outside the United States. And when gold becomes more expensive, demand tends to fall. But that's not the only reason. Gold does not produce income. It doesn't pay interest or dividends. So when interest rates are high, investors have better alternatives. They can earn returns from bonds, savings accounts, or other income-generating assets. This reduces the attractiveness of gold. Now let's move to the geopolitical side. Normally, when there is conflict or tension in the world, investors turn to gold as a safe haven. That's why many people expected gold to rise with increasing tensions around Iran. But markets don't always react the way people expect. In many cases, markets price in expectations before events actually happen. This is known as buy the rumor, sell the news. Investors anticipate a potential conflict, buy gold early, and push prices up. But once the event actually happens, many investors start taking profits. That creates selling pressure, and prices begin to fall. So in this case, the geopolitical risk may have already been priced into gold. And when the expected developments occurred, the market reacted by selling. There is also another important factor: liquidity. In uncertain environments, some investors prefer to hold cash, especially US dollars. This creates additional demand for the dollar. And as the dollar strengthens, gold often moves in the opposite direction. So now we have multiple forces working against gold at the same time. A strong dollar, high interest rates, and profit-taking after expectations were already priced in. All of these factors together explain why gold is falling, even during uncertainty. But what does this mean for investors? For long-term investors, gold can still play an important role in a portfolio. It can act as a hedge against inflation and currency risk. However, in the short term, gold prices can be highly volatile. They are influenced by central bank policies, global events, and investor sentiment. That's why relying only on gold can be risky. A diversified portfolio is usually a more balanced approach. Investors often combine gold with stocks, bonds, and other assets to reduce overall risk. It's also important to understand that markets are forward-looking. They react not only to what is happening today, but to what investors expect will happen in the future. So even if tensions increase, if the market already expects it, prices may not react the way you think. On the other hand, unexpected developments can cause sharp movements. For example, if the Federal Reserve suddenly signals rate cuts, gold could rise quickly. Or if geopolitical tensions escalate beyond expectations, safe haven demand could increase again. This is why timing the market is extremely difficult. Instead, many experienced investors focus on long-term strategies. They invest consistently, manage risk, and avoid emotional decisions. In summary, gold is falling right now because of a strong US dollar, high interest rates, and the fact that geopolitical risks were already priced in. Even though uncertainty remains, markets have already reacted to those expectations. And now, investors are adjusting their positions. If you want to understand markets better and learn how to build long-term wealth, make sure to subscribe for more clear and simple explanations.